Snowflake came out with earnings last night, and based on the market's reaction, it is not happy with what it saw. So, what happened at Snowflake during this quarter? My name is Brian Stoffel, and over the next 10 minutes, we're going to find out. As of the time of this recording, I do own shares of Snowflake. So, this is the company's fiscal 2023 fourth quarter. Market cap is about $46 billion after the open today. On the top line, lot to like, 54% growth that beat Wall Street's estimates. Management only guides for its product revenue, but it beat that guidance. So it was a beat straight across on the top line, and much the same on the bottom. On a non-GAAP basis, earnings per share were 14 cents. That was better than the 12 cents last year, and it was well ahead of Wall Street's estimates. Let's take a look at margins. Gross margins, this is just for the product revenue, were steady at 75%. Operating margin ticked up over 100 basis points, or about 90 basis points. That is very important to see. Net margin went down, but that has to do with some wonky balance sheet things. Overall, pretty good. All of these on a non-GAAP basis. Free cash flow more than doubled to over $200 million. Net income went up, but by much smaller margin. And this balance sheet is in stellar position with $4 billion in cash, zero long-term debt. Now, the company did say that they saw a measure of bookings reticence. Now, remember, people pay upfront to use Snowflake, and then they use up their credits over time. So those bookings are very important. They say they saw a reticence with certain customer segments in the fourth quarter because they lacked visibility into their business and they wanted to take a short-term stance. They especially saw this in international markets, amongst small and medium-sized businesses and commercial customers, but they did not see it nearly as much with the high end of their customer base, the large customers that they serve. It's worth noting that stock-based compensation continues to be hefty at Snowflake, $251 million in stock-based compensation, up from about $150 million last year. Shares were diluted by about 4.1% because of that throughout the year. So this is, again, something that shareholders need to keep their eye on. It is worth noting that the board of directors authorized a $2 billion share repurchase that would cancel out between about 3% of shares outstanding, possibly maybe 2 or 3. So that's worth noting. Overall, total customers grew 31%. That's pretty good progress. It was 34% last quarter, year over year. The number of $1 million customers, in other words, people that are paying Snowflake $1 million per year on a relatively recurring basis, was up 79% to 330. The larger customers continue to drive the growth here. Now, this is really important, because Snowflake's key moat is high switching costs, but they also are starting to benefit from the network effect. Why? Because you have to be a Snowflake customer to participate in data sharing, and 23 customers have at least one stable edge. That means that they are offering up their data for others to use, and they can get paid for it. People have to come and be part of Snowflake to do that. That is important, and it was up. The number of listings for this was up 8% quarter over quarter, and the number of registrants was up 16% quarter over quarter. So these are very encouraging news that aren't huge needle movers right now, but it is a growing segment that I think over time will be very important to defending this company's moat. Now, remaining performance obligations were up to $3.7 billion. It is worth noting that this is actually a little bit alarming. Usually the remaining performance obligations is around the revenue growth, sometimes faster than the revenue growth, which means there's more coming down the pipeline. Here, that's not the case. Remember, revenue growth was about 54% and RPO is just 38%. That points to some of the reticence that management was talking about on the conference call, and probably helps explain why investors are being a little skittish right now after these earnings. Net revenue retention ticked down, but remember, this is probably some of the best net revenue retention you're ever going to see, 158%. That means Snowflake is not only holding on to all of its customers, but getting the existing ones to spend 58% more than they did last year, and that's on top of 177% in the year ago quarter. Impressive. Operating leverage continues to improve as well. All of these are sales and marketing, research and development, and overhead costs as a percentage of revenue. And you can see it ticking down, ticking down, ticking down. All of that helps their adjusted free cash flow as a percentage of revenue tick up. It's currently sitting at 25%. So 25% of the cash that the company brings in gets converted into free cash flow. Turning to guidance, management guided for product revenue to grow at about 45% at the midpoint. Now, Wall Street's expecting $621 million, but some of that delta there is because it doesn't include service revenue. The important thing here is that they're saying 45% growth. Wall Street was hoping for 47% growth. Bottom line, not much of an importance right now. That shortfall management talked about, they are making slight changes to their full year outlook because of existing customer purchasing behavior, lower than expected new logo bookings, which means they're getting new customers at a slower rate than they expected. And those younger cohorts aren't ramping up. Their dollar-based net retention rate isn't growing as quickly as they expected. So those things are combining, leading them to pull back a little bit on guidance. And you could really see that in the full year guidance. Management's forecasting 40% product growth. Wall Street's expecting overall growth of 45%. And when you're a high growth stock like Snowflake, things like that can spook people. Bottom line, on a non-GAAP basis, Wall Street's expecting earnings to grow significantly. So that's something to keep your eye on. Moving forward, what am I going to watch as a shareholder? First is that net revenue retention. I'd like to stay above 140%. At least in the next quarter, to show me that they're not pulling back altogether on their spending. Second, the number of $1 million customers. We saw that grow over 70%. That's great. Third, those stable edge customers. That's not a huge difference maker now, but I think it could be in the future, especially for the moat. And fourth, keep an eye on free cash flow. Altogether, I think the moat is definitely widening around this company, and the thesis is on track if it is a little bit scarier now because business is slowing. But that is not surprising given the fact that Snowflake tailors to tech companies, and tech companies are the ones that are facing the biggest crunches right now over everyone. Now, overall, this gets a 12 on my anti-fragility score, but we've got to take a look at valuation. And speaking of valuation, Brian Feroldi and I are going to hold a free, absolutely 100% free seminar or webinar on valuation and the valuation mindset spectrum. We'll tell you about what makes the difference between a Mark Andreessen, David Gardner, or Kathy Wood as opposed to a David Gardner or a Ben Graham. So join us for that. It is live. You'll get a chance to ask questions live in the Q&A. That's on next Tuesday, March 7th from 11 to 12 Central Time. 12 to 1 Eastern Time. Just click on the show link in the notes below and you can register for this. You have to register to attend. But getting to that valuation, we believe that right now, Snowflake's probably between stage 2 and stage 3. If you look at free cash flow, they're pretty solidly in stage 3 right now, which means that really just revenue and gross profit are optimized right now. Everything else pretty much isn't, although they're moving closer, which means that there's only a couple metrics to look at. So if we look at the price to sales ratio, it is sky high overall. It'll be about 22 after today's open. Now, that's lower than it's ever been, but it's still very high. On a price to gross profit ratio, gross profit's about 1.44 billion, so it's trading at about 32 times gross profit. If we look at price to free cash flow, it was trading at about 140 times. It's now at about 95 times free cash flow. Still very expensive, no doubt about it. I also ran a reverse discounted cash flow model on this now using the assumption of a terminal growth rate of 2.5% and a discount rate of 10%. The implied growth rate at today's opening price is about 30%. In other words, Snowflake's going to have to grow its free cash flow at about 30% per year over the next 10 years to justify this stock price. And so what I have to ask myself then as I make a small adjustment to the score is, how reasonable is that? Is it very reasonable? Is it highly unlikely? And that will cause a change. And when I think about 30% growth rate, well, if they're able to pull off stable free cash flow conversion of 25%, and they're growing at about 45%, well, they should be able to pull that off over the next year. But over 10 years, I'm stuck between saying it's right here and right here, so I'll split the difference and take 3/4 of a point off. That brings the score to an 11.25. Again, I want to remind people that if you click on the link in the notes below, you can register for our absolutely free webinar next Tuesday, the Valuation Spectrum Mindset. We think it'll be really fun for people to join with. But that's where I land on Snowflake. I think that the company is executing very well. There's just some macro issues that are holding it back right now. And when you're a high growth stock, this is what happens to your stock price. I won't be selling my shares anytime soon. Let me know what you think of this in the show notes below, and make sure to give us a thumbs up. It helps us get discovered. That's it for now. Brian